Dr. Bhala, who's also the advisor on EGROW Foundation and now serving as the executive director at the IMF, Washington. As you know, our Friday evening series are making an attempt to get the best minds across the country and the world to speak to us on important contemporary issues. The foundation itself focuses on policy-oriented research and research-based policy advice. It is in this context that we have had series of lectures on inflation targeting. And in that series, which we have been covering for 5 weeks, today is the last lecture being delivered by none else than Dr. Bhala, who has been working on this for many years. And in the shadow monetary policy, he has been also actively talking about inflation targeting. And today he's making a presentation. With this, I hand over the session to Dr. Arvind Virmani, Chairman of EGROW Foundation, to chair the session and take the proceeding further. Thank you. Dr. Virmani, please.
Thank you. I'm sure we are going to have a long session, so I don't want to waste too much time. Charan has already introduced, but before Dr. Bhala became ED IMF, he was also the member of the PM's Economic Advisory Council. But I just want to add that, in my long association with him before that, I found him to be the best empirical economist and a policy-oriented empirical economist. So, which is why one of the reasons why we have him on our EGROW advisory board. That combination of, kind of good attention to data, to facts, and translation into policy, as against many academics who focus only on academic issues and theoretical issues. There are a lot of Indians, particularly many settled abroad, who focus on theory of different kinds and on academic publications. But I think Dr. Bhala has been one of the few who has focused on empirical work, on data work and policy. With that, his latest research, as he was just saying, maybe you will introduce. Are you going to use a PowerPoint presentation?
Yes.
Oh, so you'll have to put it on. So
yeah.
Okay, go ahead. You put on the sharing. Yeah.
Okay. Thank you very much, Charan and Arvind, and appreciate your warm introduction. First, that this is a joint paper with Karan, who I've been working with on several projects for the last 3-4 years. This is part of a larger study on inflation, not just in India, not just inflation targeting, but in the world. And this segment is on inflation targeting and inflation in India. One point I want to make, that's perfect. Look, what our basic strategy is to look at what has happened to inflation in India, what kind of policies did it lead to, and what has happened to inflation in the world. No man is an island, no country is an island. And that's one of the big themes in our research, that it is globalization that may be responsible for the decline in inflation, in global inflation, and therefore the decline in Indian inflation. As you know, from the various studies that have you yourself or your EGROW has hosted, that inflation did decline in India post 2014. And what we contend is that maybe inflation targeting had very little to do with the decline in inflation. We support that empirically, econometrically, and graphically. In this presentation, we will basically use a lot of graphs because I think pictures tell a lot more stories than econometric equations. But nevertheless, each of these is backed up by, for those interested in causality testing and various other econometric fireworks, that is there in the paper that we have also finished and or in the process of finishing. Next slide, please. Look, let's just, these two graphs, I think, tell a lot of the story. There is, and as you will see, the other graphs will supplement, but this is the most basic story about EM inflation and Indian inflation. So one, what we look at is that, look at the blue line is advanced economies, and there was a spike up in the mid 70s to late 70s to above 10%. This is median inflation. Advanced economies was 10% plus after the oil crisis. And then there was a steep fall. And basically, since 1990, for a very brief time, it reached 5%, and now has been somewhere around, if you look at the right-hand side of the graph, that from 96, basically median EM inflation has hovered around 2%, and obviously declining in 2015, 16 to 1%. That was the time period when we all said that, when it was observed that trade growth or growth in exports, world exports, was actually lower than GDP growth for the first time in post-war history. Look at also the red line, which is the EMs, and that also has shown a steep decline. The 2007-8 is the spike which is observed in EMs because of the global crisis of commodity inflation, but a very brief time period, and after that it has declined. Next slide, please. This is, one of the biggest stories we believe about global inflation. This is a gap between EM inflation and AE inflation. Again, both of them measured as the median inflation. And you have that basically, except for a couple of spikes, that it was around 3, 4, 5%. And today, you have to go back to the 1960s in order to find EM inflation that close. And indeed, in the 60s, EM inflation was lower than advanced economies, but there weren't that many EMs and so on and so forth, and we don't know about the data at that time period. The fact remains that today, which is what the period we are talking about, inflation targeting, etc., the last 5, 6, 7 years, EM inflation and and advanced economy inflation is very, very little, 1 to 2%, historically low levels. Now, this chart shows what has happened to Indian inflation during this time period, again, from 1960 onwards. And what we have here, there's a close tracking. Obviously, there are time periods in the 70s when we spiked much higher. I think in 1974, after the oil crisis, 73, we reached 25% inflation, and then fell immediately the next year to -5. But the fact remains that you take out those blips, and we will be discussing oil inflation in a minute, but you take out those blips, and not surprisingly, in our view, you have that the Indian inflation tracks closely, except for the time period, and which we will discuss in future slides, except for the time periods 2006 to 2013, when we had very high inflation in India, and the world had, and the EM world had opposite low inflation. Next slide, please. Okay, the first thing that we have found, and I'm sure all of you have found, constantly in India at least, there is now constant talk about oil prices and what oil prices will do to inflation. Interestingly enough, this is not the discussion in the Western world at all, about oil prices move all the way from, $25 just 2-3 years ago to now $60 and maybe $65, maybe down. So oil prices are not discussed in the developed world, and really not many other parts of the world. And look at and obviously in the 70s, oil prices had their day in terms of they indeed caused worldwide inflation. We all know that. And just to keep in mind, oil prices went up 8 times, 4 times in 1973. This is international oil prices, and doubled in 1979. And so therefore 8 times during that time period. And obviously world inflation was unleashed. Now let's look at the time period that is in red. Just go back here. 2000, 2004, 2005 to 2009, and then onwards. You have oil prices rising at, the IMF energy price inflation shows 19%, and yet we saw world inflation and Indian inflation at very, very historically low levels. The other statistic that I much like to cite is that in 1998, oil prices were something like $11 a barrel. In 2007-8, they peaked at 140, but they stayed above 100 for quite a bit of time. So that is, more than 10 times international oil prices went up. And what happened to world inflation? It went down. So I think we should move away from this looking at oil prices to find out anything about inflation practically anywhere. This is overall inflation. Obviously, oil will go up, energy inflation will go up, but not the overall price inflation. Next slide. Okay, let's look at what is the conventional wisdom on inflation. And, we've all studied it, etc. And they are either domestic factors responsible or the international factors. And we just discussed one of those international factors being oil prices. But now I think what we find, and all the evidence seems to point that way, that globalization has changed the equation, and that domestic factors are no longer that important, which is why we see, there are 180 countries, there are more than 150 countries in emerging or developing economies, there are about 20-30 25 advanced economies, and inflation everywhere is low. So clearly there's something going on, and what we will show and do show that what is going on has precious little to do with inflation targeting. But I want to discuss one domestic factor for India's inflation is MSP. Again, it's logical if you don't allow international prices to influence your domestic prices, then clearly domestic prices will play a role. And let's just examine the role that MSP increases have played. Next slide. And this is a simple model. And what we do is we take the data, all the data from 1978 onwards. That's the earliest data we have, MSP prices, etc. And very simply, the left-hand side is CPI inflation, and the right-hand side is CPI inflation lagged, because it's very important. One of the things we observe that many authors, unfortunately, do not control for the own lagged inflation, because that has a lot of information. So what you want to find out is what do you do once you control for own inflation and once you control for international inflation. This is a very, very simple model. It shows that each 10% MSP increase. Now, if we had a free export market and import market and food, we won't find the MSPs playing an important role. But here they played a rather important role. The coefficient is about 0.18. You do various estimations, somewhere between 0.15 and 0.25, that is each. So a 10% increase in MSP will lead to something like a 2 percentage point increase in ceteris paribus in overall inflation. And indeed, that is what we observed very recently, just a year ago. Next slide, please. And this shows you, look at this fit. And I don't think you can really point to the difference between the two. What we want to point out here is that the red line is the inflation out of sample prediction from 2013 onwards, 2014 onwards. The model is estimated till 2013. And there's a very close fit between MSP and inflation after controlling for international effects. And there's a very close fit post 2013. Now, the first report on inflation targeting came out in 2014. Now, this graph has no information that we had inflation targeting or didn't have inflation targeting. And this is a prominent and an important conclusion. Look at the steep decline in the predicted inflation and the actual inflation post 2013. So I think, we have to be really, one of the things that we have observed is there's on the inflation targeting has become an emotive issue rather than an empirical issue. Our approach is this is an empirical matter. Let's find out if inflation targeting has worked or not. But I think, basically one should end the lecture over here on inflation targeting because it shows that there are other factors. And basically, as I said, there are international factors and the MSP factor, which explains divergence of India's inflation from, let us say, the median inflation from what is going on. Next slide, please. And this is again more or less the same and shows takes a 3-period average and shows the steep decline that preceded inflation targeting, even conceptualization of inflation targeting, which first came out in the 2014 report by Ujit Patel and by the RBI. And notice that the steep decline from 10-11% to something like 7% at the time the report was written. So next slide. Okay, so we now take a sort of a historical view, global view, and we'll come back to the Indian inflation targeting. in a few minutes or in a few slides. And look, remember the olden days where famously inflation everywhere and always was a monetary phenomenon. And that was a conventional wisdom. And it stopped actually, interestingly, in 1984. This is obviously Friedman. Friedman was very much there and had already received the Nobel Prize. But in 1984, the US stopped releasing weekly money supply forecasts or estimates of how much money supply had gone up. And this was always at 4:15 in the afternoon. The markets were closed and everybody was glued. Everybody interested in the markets, financial markets, was glued to what the estimate of the weekly money supply figure was. And I remember sometime prior to them releasing this, that the money supply figure was very high and the bond market rallied. So the bond market had seen much before the US officially stopped releasing the weekly supply. At the same time, as we all were looking at inflation, and this really came out from, as I said, that the 70s period played havoc with all of us in terms of our thinking, and our thinking changed. We had very high inflation. Globalization was just starting. And I think we all confounded the two influences. So then everybody, including myself and several others, or practically any macroeconomist would estimate a Phillips curve. And the Phillips curve has wage inflation, not CPI, on the left-hand side, and unemployment rates on the right-hand side. And obviously, as you all have read, that there is constant talk about the flattening of the Phillips curve. And it turns out that the Phillips curve flattened out, as we showed in the previous, somewhere in the mid-1990s. So the Phillips curve has been flat for more than 20 years. While we look at monthly data in order to find out what has happened to Phillips curve, but just look at the averages, and really, as we've shown, the Phillips curve stopped being flat, and all of that. And I've argued, and we've done some more work on this, that the reason the Phillips curve is flat, or the reason the Phillips curve is flat, is basically the wage inflation has practically disappeared. And wage inflation has practically disappeared around the world because of globalization. And what do we mean by globalization? Because of the fact that everybody now gets a college education, and the supply of college-educated labor around the world has really zoomed. In 1996, college-educated labor, the new graduates in the advanced economies, the new graduates was equal to that in the rest of the world. And now it is about 3.5 to 4 times. So you've got this, and maybe at some other occasion we can talk about what has happened to college-educated wages in India. And I think the three of us, Arvind and Karan and I, have discussed this elsewhere. But basically, that's the big story we believe about low inflation is globalization. But globalization means many things. Very simply, wages of college-educated laborers has been relatively flat. Next slide, please. Okay, and look, what this evidence points to, and what we have discussed, is that flat wage growth means a flat Phillips curve and means flat inflation. And that is why throughout the discussion of Phillips curve, it was not the CPI. Everybody recognized that the CPI will have momentary or transient spikes and troughs depending on energy inflation and food inflation. But that really you need to look at wage growth in order to find out. Next slide, please. Okay. Now, an important question comes up given our results. And that question is it the case that monetary policy does not matter? And we have a very affirmative answer, a very precise answer that yes, monetary policy does not matter when it comes to inflation. But monetary policy, for the very same reasons that we've talked about globalization, etc., is very important when it comes to the setting of real interest policy rates, because the cost of capital will be different. The real cost of capital will be different in different economies. And that affects productivity growth, that affects overall growth. And therefore, and we show that this was one of the major fault lines in Indian monetary policy between 2015-16 and 2018-19. Next slide, please. Okay. One other, what we will discuss now, if you peruse the literature, study the literature, various reasons have been offered for the role of inflation targeting. And we'll now look at in detail as to what has been the role of inflation targeting, looking at countries that did adopt inflation targeting versus countries that didn't, and so on and so forth. The key point we want to find out, as we've discussed and as we've shown, that inflation started to decline, median, etc., somewhere in the 1990s. And the first inflation targeting happened in New Zealand in 1989, completely coincident with, and that's what we claim and we show, that really what analysts need to consider is the first lesson in econometrics and first lesson in conceptual policy making, as well as understanding, is it correlation or is it a causation? And I think the correlation has been used by several experts to attribute causation. And that's what we'll try and now investigate. Is that attribution correct? Next slide, please. Okay. Before we go, one of the prominent statements of one of the prominent aspects about inflation targeting is the central goal or central target of 4% inflation. And our own research shows that this was a very, very appropriate target that came out in the 2014 report. And just want to show that maybe this is where the 4% was obtained. First, that the EM inflation for the previous 5 years, etc., was 3.9%. So that's, if somebody is looking at the data in 2014, they obviously will be looking at world inflation. And in world inflation, EM inflation is much more relevant to us, is very relevant for the Indian condition. Second, look at this line, Indian inflation 1999 to 2005. Now this is a full decade plus before inflation targeting was even conceived of in India. And at that time, the average inflation rate was 4%. 98 was a big onion inflation. And after that, boom, average of 4%. And the lowest standard deviation, the lowest variation in inflation rates, boom, 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 every year was very close to 4%. And that's, as I said, as we said, a decade before. Okay, what we're going to do now is very quickly examine these various aspects of inflation targeting and the various explanations that have been offered. And one of our key methods would be to compare inflation in IT, that is inflation targeting countries, with non-inflation targeting countries. Next slide, please. Okay, one of the, and this is, a quote, this is something that the Fed has said, this is something that the IMF has said, this is a quote from Geeta Gopinath, who's the chief economist at the fund, is that another important factor behind low inflation is that expectations of inflation will remain broadly stable around the targets set by central banks, thanks to central banks' independence and the credibility of their policies. Now, this is the another derivation as to why there has been low inflation. Not so much inflation targeting, but yes, inflation targeting, the argument is made, inflation targeting led to central banks' independence because they were independent from the policymakers or from the fiscal policymakers or government bureaucrats, and that they were credible. Now, if this were the case, and that's what we'll go out and test, then you should find that non-inflation targeting countries do not have, quote unquote, central bank independence and do not have, quote unquote, credibility in their policies. And therefore, we should find non-inflation targeting countries to have consistently a higher inflation rate than the inflation targeting countries. Both sets are being affected by global inflation, but one does not have it. We'll now examine whether this is correct. And before we, this point we've made before that look, and the trend, no matter how you look at it, we find that the inflation targeting in India came a bit late in the game with the inflation decline, and therefore it is incorrect to attribute. Next slide, please. And this is, let's look at this. This is where we take 3 decades and we compare and notice a number of countries non-IT. And let's look at 2010 to 19. The average inflation in inflation targeting countries was 4%, and in non-IT countries was 3.5%. If you look at a median inflation in IT regime countries was 3.1, in non-IT regime countries was 3.1. If you look at 2000 to 2009, it was 5 versus 4.7. Only in 1990 to 99, you have that the non-IT regime median countries was higher. But for 20 years, and this is when IT was introduced, that really you can't find a positive role for inflation targeting in reducing inflation. Next slide, please. Okay. Now, so we've shown that, look, inflation targeting did not affect inflation. And this is accepted by most, even by the IT enthusiasts. But now the IT enthusiasts say that, look, inflations are better anchored because of inflation targeting regime. So that's the new mantra, that inflation, the reason inflation is low is because inflation is better anchored. And mind you, this is something that policymakers, central bankers, central bank governors, the ECB, the Fed, This is now the new mantra around the world. At the same time, I should mention that in 2019, at the Jackson Hole meeting, Fed Chairman Powell said that they were doing a study on what has happened, why wage inflation has been so low in the developed world, in the US, and they were going to do a study as to find out the causes. Nothing has come out so far, but the point is that low inflation, you can go to Japan, you can go to Germany, you can go wherever. This is a phenomenon. I mean, central banks are fighting to raise inflation. So therefore, the anchoring of long-run inflation expectations, they themselves contradict when they argue for that, look, it's the anchoring. At the same time, if they were so well anchored, and they are trying to raise inflation, so the communication, the credibility of the central bank is we want inflation to be higher, and they keep coming short. It's not higher, so maybe they're losing credibility. On the other hand, it is a case that, you know, maybe they can't affect inflation. Next slide, please. Okay, so now we'll look at a little bit more detail, and let's go to the next slide on what is the evidence. And what we have over here is these are professional forecasters. You know, I've written a lot on the uselessness of the household survey that the RBI has been conducting on inflation since 2008, which doesn't show any variation whatsoever and is consistently between 8 and 9% no matter what happens. So I won't go into that. But here, what we look at, the green line is the 10-year ahead inflation expectations in the emerging markets. And what we find is that has been relatively constant from 2000 to 2000 now, regardless of the actual level of inflation. And the same story is observed with a 5-year ahead inflation expectations. Expectations have been anchored and are completely have been anchored at a high level, higher than the actual observed level. Look at the since about 2007-8, the median inflation has been consistently lower and considerably lower than the 5-year ahead inflation expectations. Next slide. And this again shows, this is the RBI data, which is in the red line. And you can see that basically it was 12% during the high inflation phase, and now it is close to 10%. So let's ignore this. Next slide. This again, you know, I want to emphasize what we're showing in this graph or in this slide. And that is that, look, if it was the case that inflation targeting worked, then you should have that the output gap. First of all, the two conclusions emerge from this. The output gap, and we define it as when GDP growth was equal to potential growth, and we measure that econometrically. What you should find is, this was, remember, the Phillips curve. This is, so when there is zero output gap, you should have higher inflation. When you have low zero output gap or negative output gap, you should have low inflation. And it doesn't matter. You do have declining inflation. From 1990 to 99, it was 7.2 in the emerging markets, and it was 5.6 in the non-IT emerging markets. And both of them have shown a significant decline. And the IT regime actually has, at zero output gap, has a higher inflation rate, 3.9%, than the 3.4% observed in the non-IT regime. So two conclusions. One, inflation has declined even at zero output gap. And second, that there's very little difference, and indeed the non-IT regime may have done better. Next slide, please. Okay, so this is, summarizing the evidence, and now we'll conclude. And let's go to the next slide. That a few more slides actually. And what we want to point out here is that the costs that India paid for having inflation targeting. There was perhaps a zeal amongst the central bankers. They thought interest rates controlled inflation. We hiked up interest rates way, way high, the highest real interest rates ever observed in India. And also during 2016 to 2018, these were amongst the highest real interest rates, policy rates in the developing world. And we think that had a lot to do with the decline in GDP growth in India from something like 8% in 2016 to something like 5% just before the COVID crisis. So you don't have to look too far to find out the costs. The costs came out on the monetary side with extremely high real interest rates. And that's what we've argued earlier. High real interest rates do affect output and have precious little to do with inflation, because inflation is really controlled globally. It's out there like manna from heaven and is determining. Next slide, please. And this is again documenting, see the gray line is a real repo rate, and the blue line, sorry, is a real repo rate. And that is interesting, that it is the flat line is 1.25%, which the RBI says is the neutral real rate. And basically, we've just been a few months that we have been below the 1.25%, and only now in 2019 did we proceed to have. And those high real repo rates, again, what we had said earlier, have been the causal influence behind very low growth or declining growth in India. Next slide, please. Yeah, let's go. And this is again, inflation was well within the inflation targeting range during this time period. And Arvind, I know, and Karan and I, amongst others, have been pointing this out consistently, that we went astray, or monetary policy went astray, and started becoming realistic in 2019. And then, of course, COVID hit. We'll now see what the effects are, maybe in a year or two. But I think our argument is, our expectation is that given that we have realistic repo rates that correspond to real activity, and that they are negative. We forget that for a very, very long time in India, repo rates, real repo rates were not only negative, but hugely negative. That, I think, may have been a mistake at part of the time, but nevertheless, that the concentration and the emphasis was on growth. And I think there are indications that we're getting back to the growth being an important aspect of monetary policy. Next slide. So, essentially, what we get, and this is our concluding slide, that really, IT had very little role to do with the decline in inflation. That's one real big conclusion that we have. Second, real big conclusion that the world inflation has been declining, and last year was COVID, so it was declined even more. There was hardly any activity, so prices fell. And this year, we'll certainly get higher, and certainly, there's no such thing as certainly. But inflation around the world should be higher this year, and starting in 22, we should be back to basics. So we should ignore both 2020 and 21 in our analysis of inflation trends worldwide. And maybe a year from now, we can meet again and analyze what has happened. But that's our expectation, that look, if something has been observed for the last 20, 30 years, and globally across 150, 160, 170 countries, that COVID and the snapback from COVID is not going to change that fundamental result and that fundamental equation. I will end on that note. Thank you very much.
Thank you. So let me just make a few points before opening it up to questions. So let me start in the last thing. Of course, there is, of course, our EGROW paper on the J curve, which Karan has read, but perhaps you have not, which analyze the effect of the real rate tightening resulting from inflation targeting on growth in the context of other hypotheses and other factors. So that's something, if you're going to, your paper covers growth also, then you might want to at least give a reference to that, Karan. Now, I think the what I want to point out is really your results on the agriculture, the MSP. I think those are very important. Or let me start with oil. Yeah, I mean, oil. I think the increasingly, my initial work on oil really had more of a effect. The oil price changes had a bigger effect on GDP. It's a funny, which is kind of consistent with your overall approach. Actually, is that oil shock in my early studies on the 80s showed that the oil shock actually had a negative effect on growth, and I tried to figure out, and the hypothesis I came up with was it's like a transfer of, it's like a tax imposed by an external agency, because it's an inelastic in the short term, and really it's like transfer of income which slows down the investment and growth. It's so that's what my paper on the effect of those 70s, 80s oil price you showed. Now, so that's one aspect. The other is food. I think food, you really made a very important contribution, which you had done earlier also, and you should certainly, in an IMF paper, you should certainly emphasize that. And really, again, this is an old issue. The way one has looked at it is that Indian agriculture has been less or not affected by QRs because we have a QR. We have QRs. We've shut off the agricultural sector from the rest of the world, and therefore we've created a non-tradable. I mean, in countries where it is open, it's linked to global prices, and therefore you will not have these big shock effects of the domestic supply side. But because we have put barriers and quantity restriction, and of course I personally dealt with them as an, as CA and other things, of how slow and arbitrary those things are to change. And one would expect, just looking at the simple logic, that if you have a domestic shock and you cut off your agriculture, there'll be an effect on prices. I mean, it doesn't even require, and the overall effect. So, but the interesting thing which our recent inflation targeting have pointed out, and I'm not sure this is true, that they are saying this effect has gone down, that perhaps it was. So the question is, are we liberalizing agriculture implicitly so that its prices have become more related to the international seen, and therefore the domestic supply shocks maybe are having a smaller effect in more recent times. I'm not so sure. So that's an issue which you might want to reflect on, but your MSP thing certainly stands. Let me see. Is there any other? Yeah. So I should just highlight. I'm not sure I have a comment yet, but the whole thing about the supply curve of labor, the Phillips curve, and the role of inflation expectations. Now, again, I think we had an earlier talk where one person agreed with you that actually the broad trend, I think you're right on this. There seems to be a consensus that of the flattening of the Phillips curve. Yes, so I think that you're on track. The expectation one, there's a difference of opinion. I think we had one speaker which claimed to have shown, I didn't see the exact results, but we can discuss that later, who the person is, and one who said that he found no effects. So there are two people who spoke to us who tried to see the effects on inflation expectations in different forms. Again, I'm not sure. One person, of course, used the consumer expectation. I don't recall exactly what the other one did, but one seemed to think that there are no effects, like you are saying, and one which seemed to think there are some effects. So perhaps if you can do a little bit more exploration on the Indian thing on expectation, that would be helpful to the argument and the discussion. Well, let me leave it at that and invite questions from the audience. Okay, here we are. There's one question I see on the chat by Mr. Sanyal. He's saying, will removal of will not removal of MSP. That means if you remove MSP, won't you get an increase in the spikes of inflation on both sides? I don't know if you want to try and answer that question. I guess he's talking about the supply side. If there's no MSP, then will supply side become more volatile or something like that? It seems to be the intent. Sujit, you're mute. Mute. Yeah. Okay.
Especially in the context of
yeah, now you can start. You were mute earlier.
Yeah. I said, especially in the context of the new farm laws, this is an important question, and we have investigated this and perhaps another presentation, but there is very little output effects of MSP. And what you have is that only the privileged few have been able to get the MSP price. But it does set in the floor level and in terms of what the farmers obtain. And I think what you do get is that particularly in the 2006 to 2013, where the food prices really, MSP prices really went through the roof and fed into expectations, fed into non-farm labor, fed into rural wages, etc. So I think the linkage is from farm prices to wages. And in that sense, again, we would expect that whether you have MSP or not, that the linkage in the future will decline. And that is indeed what you do get. So, but if you have a spike like we did in 2018, a 10% increase in MSP, it will have an effect. But, it's starting in 2000. Actually, another aspect of this is that starting in 2013, August, when the MSP, after going at double digits, and 20% even a couple of years, went down to 5% from 13, 14% the previous year, and I think had a role. Going forward, look, if we allow international food prices to come in, you will get a stabilization. And the other aspect here is that the food share in India, and this is for another paper, which we have discussed, in the CPI is 46%, whereas in the national accounts, it is something like 28%. So it is a high food share, unrealistically high food share, which emerges from what we feel have been flawed consumer expenditure survey, and that's again another debate. But I think going forward, we should expect less of a role of MSP and whether it is administered or not, and who gets it or not. And I think more linkage between Indian food prices and international food prices. Some of it is already there. So one of the things that we've argued is that we should, which many of us have argued. Certainly, if you're an economist, you've argued that we shouldn't be doing sudden stops in terms of exports or imports of food products.
Last question.
Yeah, I will take you in a little while. Pawan, hold on. I've got 2 or 3 other questions. One question is from Ranjit Kumar Prasad. It's a general question. Is inflation helpful to a poor country like India? So he's kind of, I guess, asking whether, is high inflation or low inflation, or what might be the good inflation? Sujit?
No, that's the really, whether it is a helpful or not helpful is, can you do anything about it? So as I said, central banks around the world have been, inflation helps debtors and so on and so forth. And, I think, look, the world has changed. And it may be we can show it has been helpful, not helpful, but I really don't think if you can't do anything about it, which is our central conclusion, then let's not worry about it.
Okay, Pawan, you can ask your question, then I'll come to the other ones.
Thanks a lot for this opportunity, sir. I'm in my final year of Masters in Economics from the University of Hyderabad. So my question, I actually have written a general paper on this very same topic. So my question is, India has been adopting what is known as multi-indicator approach to monitor inflation in the past. So would it be prudent enough to shift back to that approach to control inflation rather than solely focus on only inflation? And a follow-up is, if this is the situation, what would be the future for inflation targeting? Can we control it by a multi-indicator approach again?
No, that's a very good. Very quickly, I think multi-indicator approach is really looking at both growth and inflation. So growth takes into account several indicators is there. And I think that's been the approach of monetary policy forever and should be the approach forever. Inflation targeting came in for reasons that we discuss, some of them are not clear. But I think the world and policymakers around the world in developed countries and developing countries are coming back to, they don't call it multi-indicator as much as they call it, we have to look at both growth and inflation. So, yeah.
Okay, the next question, Pooja or Pujita, would you like to ask the question or should I read it? Is Pujita there? Okay, I'll read it out. She's saying when we are talking about impact of inflation targeting on growth, how are you actually measuring growth? Because, oh, she's talking about the break in the series, 213, 14, there's a
Yeah.
change in series, etc. So just a short, yeah.
Yeah, the break, we have, linked series, etc. So the break in the series doesn't have, we've accounted for the break in the series by linking it, which is what everybody else does and is the correct way. But it doesn't really make much difference or any difference.
Okay. Yeah, so there is a linkage, there's standard ways to do it, which is what has been done. Now, it's there's a related question on farm laws. I don't know if you want to say anything else. It says, what will be the impact of farm laws on food inflation?
What will be the impact of farm laws on food inflation?
Yeah.
As this was the earlier question, it's a good question, and I don't think. I think the food inflation will be more stable, and I think if anything, what productivity of farmers will go up, their incomes will go up, and the prices need not necessarily go up. I mean, there's a standard productivity increases, increase incomes, and decreases inflation. Ceteris paribus.
Okay, another question which is also a little strange, but maybe you have an answer. What is the impact of inflation on university? This is Dr. Ramesh Chandra Nayak says, what is the impact of inflation on university education in India? I presume he means education inflation.
No,
Mr.
yeah.
Nayak,
No,
Dr. Nayak,
what
do you
we've
want to?
seen, and actually, I think there's a lot of going on around the world on that, and which links up very much to our study. Um, University education showed a large rate of return all across the world. And that led to a proliferation. I mean, one statistic is that now, there are more girls, young women in college than young men in India. And this has happened worldwide. India has actually led this explosion. So first, everybody's getting educated, everybody's getting a higher education. And what this has done is that if you go into private universities, and the same problem is happening here in the US, the private universities will not be able to charge as much. So there has been the education cost inflation around the world. And I think we are witnessing, a couple of years, we'll see a decline in the relative cost of education around the world, and therefore a diminishing impact on whatever. So yes, education costs have been much higher than anything else. Health costs, I think, because of COVID and so on and so forth, will also spike up. The relative price of health, when I say spike, the relative cost of education has spiked up around the world for the last 10 years, and I think now is on proceeding to a decline.
Okay, let's see. I think there's Mr. Such. Well, let's go on. We've discussed MSP and so on. So Mr. Vimarsh wants to know what you think about the connection between fiscal policy and inflation. And he's talking about the redistribution measures, etc. Probably thinking of the budget and other things. How does that affect inflation, if at all?
Okay, one of the results in our study, and you know about it, we've discussed it before, and I've published it before, that I challenge anybody, literally challenge anybody around the world to show me any relationship between fiscal deficits and inflation. I'd like to see a study. And there isn't one. So, and I've tried for individual countries, I've tried for collection of countries, I've tried for EM. Fiscal deficits do not. This is part of the old, again, maybe in the olden days, I mean, people point to, hyperinflation economies have high fiscal deficits, high everything. You can't attribute it to fiscal deficits or the hyperinflation to anything under the sun. They also have high money supply. But you look at most countries at most time periods, fiscal deficit is inconsequential to your estimates of inflation. It has redistribution effects, we should all be concerned with. That's what fiscal policy is there for. But like monetary policy, fiscal policy has zero effects on inflation, but can have and does have strong effects on income distribution and various other attributes.
Okay, I think I missed Dr. Charan Singh. You wanted to come in. I forgot to ask you in the beginning.
That's okay. But Krishnanand Tripathi is waiting to ask a question. If you can give him an opportunity.
Okay, sir. I have unmuted myself. Sir, just wanted to ask, keeping this target rate unchanged, in what way it will impact growth over the next 5 years, and whether inflation targeting has impacted growth historically in this country?
Okay. As I said, the inflation targeting has definitely affected growth adversely over the 2016 to 2018 period. I don't think now that you have an inflation target, which we said 4%, which is the same that we've had before, and there's very good explanation for why that is the expected inflation in India. That's the expected inflation in most parts of the world, developing world. And I think if central bankers and India as well as elsewhere are now looking at both growth and inflation in the formulation of their policy, which we had discussed earlier in one of the earlier questions, I think monetary policy will affect. Remember, we've constantly emphasized monetary policy does affect, will affect, can affect economic growth. Just inflation targeting component of monetary policy is irrelevant for inflation, is relevant for growth and as a negative. It turned out to have an extremely negative effect in 2016 to 2018.
Sir, I wanted to ask one follow-up question, if you permit me. Sir, the consumer price index, the basket of this thing, doesn't reflect modern expenditures or modern lifestyle. It doesn't truly reflect the expenditures that middle class people incur. So will you recommend a big change in this thing, the basket?
Well, we have in our research pointed out that, the US Fed has consistently used the personal consumption deflator as its index of inflation and inflation targeting or whatever they look at. And I think that is the most appropriate way to look at inflation. So I've been saying this for a very, very long time. I don't know when and if India will move towards it, but if they were to ask me, I think they should move towards it. It just gives you a better handle on what inflation is. One last point on that is that just look at services inflation and the consumer basket as done by the NSSO doesn't have phone inflation of communications, inflation of banking, and these two sectors, and even airlines, even automobiles, it's just a deeply flawed index. And what we do know is the share of services, these services that are not there at all in the CPI are about 10% of total consumption. And inflation in these sectors has been zero, if not negative. You do your math. 10% is zero or negative. You'll see what our overall inflation is really. So I think we need to recognize, either change the weights or do whatever, improve your consumer surveys, but the policymakers are getting extremely flawed information, independent of inflation targeting, from the inflation that they are measuring from the consumer price index.
Thank you, sir.
I would just add, Surjit, the CPI deflator, CPI's base is 2012-13, and the food, basket has fallen since then, by a large amount. So the effect of food inflation is overestimated in the CPI now.
Yeah.
And that
one
can
last
very
point
mess
on
up.
that, and then we have to conclude because I've got another meeting to go to, is that the CPI in 2011-12 had a 46% weight for food. The national accounts right now, as we speak, the food share is about half that. So it's close to 24-25%. So there is a gross mismatch and something that the authorities need to take care of. So I have to,
yeah. So there are a couple of other questions, but I don't know, when do you have to go?
Literally 5 minutes ago. But
okay, then we'll just end this. Charan, you want to conclude?
I'd like to conclude by making 3 announcements. It has been an excellent discussion, and I think any scholar's delight today. So the recording will be available in about 12 hours from now. You're welcome to use the recording anywhere and any way you like. The second is, tomorrow we are having Shadow Monetary Policy Committee meeting where EGROW members along with SHM discuss the forthcoming monetary policy. Tomorrow 3:30 p.m. is the Shadow EGROW Monetary Policy discussion. I'll send out the links and it will be available on our website too. On April 9, we have had series of discussion on monetary policy and inflation targeting, and tomorrow is the MPC discussion again. On April 9, we shift gears and we are going to be discussing a very important geopolitical issue, a very contemporary burning issue, Myanmar. And Colonel MP Singh, who is the founding director of EGROW Foundation and a retired army colonel who has a PhD on Myanmar and expertise on geopolitical issues, will be our presenter. So I would request you to watch out. Please join us on April 9 for a discussion, same time, 5:30 to 6:30, on Myanmar and its implications for India, the geopolitical considerations. With this, I thank Dr. Bhala, who has joined us from Washington, D.C. And I also thank Karan, who's of course joined us from India, but has done quite a bit of work along with Dr. Bhala, which Dr. Bhala kept mentioning. And I also thank Dr. Virmani to chair the session. I thank all the participants to have spared time on April 2, the Good Friday, and be with us. Thank you so much.
Thank you very much.